Revenue recognition is one of the most important and complex areas of IFRS accounting standards because it directly affects an entity's reported profitability, financial position, and performance evaluation. The DipFRS syllabus emphasizes the principles established under IFRS 15 revenue from contracts with customers, which introduced a comprehensive framework for recognizing revenue consistently across industries and transactions. The standard is based on a 5-step model designed to ensure that revenue reflects the transfer of promised goods or services to customers in an amount that represents the consideration expected in exchange. This approach improves comparability and transparency while reducing inconsistencies in previous accounting practices. Candidates are expected to understand both the conceptual framework and practical application of revenue recognition principles in various business scenarios. The first stage of the IFRS 15 model involves identifying the contract with a customer. A contract exists only when parties have approved the arrangement. Each party's rights and payment terms can be identified. The contract has commercial substance, and collection of consideration is probable. Once a valid contract is identified, entities must determine the distinct performance obligations within the agreement. Performance obligations represent promises to transfer goods or services that are separately identifiable and capable of being distinct. Proper identification is critical because revenue recognition depends on when each obligation is satisfied. Complex contracts often contain multiple obligations, requiring accountants to analyze contractual terms carefully. This process ensures that revenue reflects the actual delivery of value to customers rather than merely contractual arrangements. After identifying performance obligations, entities must determine the transaction price, which represents the amount of consideration expected in exchange for fulfilling contractual obligations. The transaction price may include fixed amounts, variable consideration, discounts, rebates, incentives, penalties, or performance bonuses. IFRS 15 requires entities to estimate variable consideration carefully using either the expected value method or the most likely amount method, while applying constraints to avoid significant future reversals. Once determined, the transaction price must be allocated to individual performance obligations based on their relative standalone selling prices. This allocation process ensures that revenue is recognized proportionately according to the value of each promised good or service. Accurate pricing allocation enhances faithful representation and improves comparability across financial statements. Revenue is recognized when or as performance obligations are satisfied through the transfer of control of goods or services to customers. Control may transfer at a point in time or over time, depending on the nature of the obligation and contractual arrangement. For obligations satisfied over time, entities must measure progress toward completion using appropriate methods such as output methods or input methods. Output methods focus on direct measurement of value transferred, while input methods measure resources consumed or efforts expended relative to total expected inputs. Selecting an appropriate method requires professional judgment and must faithfully represent the transfer of control to the customer. Consistent and reliable measurement of progress ensures that revenue reflects economic activity during reporting periods accurately. The recognition of contract costs is another important component of IFRS 15. Certain incremental costs incurred in obtaining or fulfilling contracts may be capitalized if they are expected to be recoverable. Examples include sales commissions, direct labor, materials, and other costs specifically attributable to satisfying performance obligations. Capitalized costs are subsequently amortized in a manner consistent with the transfer of goods or services to customers. However, costs that do not generate future economic benefits or are unrelated to contract fulfillment must be expensed immediately. This distinction prevents inappropriate capitalization while ensuring that financial statements properly reflect the economic substance of contractual activities. Proper accounting for contract costs contributes to improved matching between revenue recognition and related expenses. IFRS 15 also provides detailed guidance for specialized transactions that present unique accounting challenges. In principal versus agent arrangements, entities must determine whether they control goods or services before transfer to customers. Principals recognize gross revenue, while agents recognize only commission or net amounts earned. Repurchase agreements require careful assessment of whether control genuinely transfers to customers or remains with the seller. Bill and hold arrangements permit revenue recognition before physical delivery only when strict conditions are satisfied, including customer-requested delays and product readiness for delivery. Consignment arrangements require evaluation of control transfer because goods often remain under supplier ownership until sold by intermediaries. These specialized transactions require careful interpretation and application of IFRS principles to ensure accurate reporting. Revenue contracts frequently involve variable consideration and significant financing components that complicate measurement and recognition. Variable consideration may arise from discounts, rebates, refunds, bonuses, or penalties linked to future outcomes. IFRS 15 requires entities to estimate these amounts carefully and recognize revenue only to the extent that significant reversals are unlikely. Additionally, when contracts contain significant financing components, entities must adjust the transaction price to reflect the time value of money. This adjustment separates financing income or expense from revenue generated by goods or services. Such treatment ensures that financial statements accurately reflect both operational performance and financing effects. These requirements improve transparency by distinguishing revenue-generating activities from financing arrangements embedded within contracts. Overall, revenue recognition under IFRS 15 represents a comprehensive and principles-based framework that enhances consistency, transparency, and comparability in financial reporting. The DipFRS syllabus requires candidates to understand not only the technical mechanics of the 5-step model, but also the professional judgment necessary to apply the standard effectively in complex commercial environments. Revenue recognition influences profitability analysis, investor confidence, taxation, and business valuation, making it one of the most significant areas of financial reporting. Through the study of contracts, performance obligations, specialized transactions, variable consideration, and contract costs, candidates develop the expertise needed to prepare accurate financial statement extracts and apply IFRS accounting standards confidently in professional accounting practice.